Hi, Zach Bassett here again with COS Accounting and Tax, doing my compounding interest videos in conjunction with my podcast. Today we're going to talk about rental properties. It's a lot of guys, especially the 1099 direct sales guys, they really want to get into doing rental properties. I think it's the fact that they kind of understand the value of that recurring passive income more than your average W-2 person that gets kind of stuck in their ways. I feel like you think about how you're making money a lot more when you are self-employed. A lot of guys want to do rental properties. A lot of guys want to save a ton of money on taxes. There's a way to do both, but when it comes to rentals, it's going to be more about having your tax situation show higher income. So you take less expenses, and then you're gonna, with the expenses you do take, you're gonna take depreciation on vehicles if you want to get your taxes lower. So yeah, I would buy something like a nice truck or SUV if you want to lower your taxes but still have that high income. Let's say you're at $100,000 in income and you buy a $100,000 truck. You're now at zero income as far as taxes go, but for getting that rental property, you're still at $100,000. So that's super important to know the difference between which expenses are good, which ones aren't. Basically, the ones that you can depreciate are fine. It's fine to have those. You just don't want all the other expenses, kind of bringing down your income and making it look like they shouldn't loan you as much. So as far as rental properties go, what I've done to help make it just as easy as possible to get rentals, because at first it's really, really hard. First things first, you want to have a good income. That part's pretty simple. But you also want to start putting together that relationship with the bank. So I highly recommend, you go into your bank, you start asking for things like a line of credit or a business credit card, whatever it might be. You're going to want to build your credit as high as possible. But remember, at some point, the banks aren't even going to really rely on your credit score. They're going to rely more on your balance sheet and your bank statements and your profit and loss. Those are the things they're going to go off a lot more than what your credit score is, because it's really hard to gauge someone off their credit score once you've got 15 rentals and 4 businesses and this, that, and the other. So yeah, it's going to be most important just to have that relationship with the bank started. I'm telling you, you would think it wouldn't matter. It should only matter what your numbers show. It's not true. You can have one bank that really likes you start accepting a lot more loans, loaning you out a lot more than, say, if you went to a different bank and you had the same situation, they might not loan you out even half as much just because they don't know you. You haven't built a relationship with the guys that give the go-ahead and talk the underwriters into doing stuff. So really build that relationship. It's not hard to do. You go in, you make sure you have your business bank account there. You start talking with the loan officers. You start asking for those lines of credit and just setting up maybe an HSA account there, whatever you can to start building that relationship. Another big thing, if you want to do rental properties, is that you have bookkeeping done. So if you're a door-to-door guy and you make, say, $150,000 a year, you want to start having your bookkeeping done. I'd say $150K plus. Now, a lot of people wonder why that's important. It's important because the bank can actually see where you're at any month of the year, instead of looking and going, oh, let me see your last 2 years tax returns. And you might say, well, I've already made $120,000 this year. If you don't have bookkeeping, they're not going to count that 120 at all. They're going to, they could look and see in your bank statements and they still won't count it. It's really frustrating. So you want to start having bookkeeping done because now they can trust something coming from a good accounting firm and say, okay, look, he's also made this money. It can help add, 2 or 3 additional rental properties a year by having bookkeeping done. So it's that important. If you're at one a year, it's going to take a while. But if you can go from 1 to 3 to 7 to 20, your life is going to be completely different than doing the 1 a year thing. So you want to do everything possible to maximize that ability to compound your net worth. And one of the biggest things is rental properties, because it is recurring and it's passive. It can be as passive as you want it to be. So in my opinion, make things as passive as you can. There's no reason to over-involve yourself with every little thing that you do. You're going to cost yourself a lot of money in the long run. A lot of the guys doing rental properties that are in the door-to-door game and they're talking about it and all the things that they're doing, I feel like they could do themselves more of a service by paying people to do a lot of the things that they're trying to do. Bookkeeping being the main one of them. You want bookkeeping done for each property that you have and for your personal income, so you can do more and more properties. It's just a pain for you to do it. Why not have someone else do it, and you can focus on getting the next property, recruiting more guys, or actually knocking doors, making more money. Now, some of you like hands-on, that's fine if you want to do hands-on, but I think you'll find in time that it's a waste of your opportunity cost time. So definitely look into getting bookkeeping done. Keep the amount of work that you do on each one to a minimum, that way you can go on to the next one, then the next one, then the next one. Focus on things like going out and looking for the properties and finding the right property. Researching, zip codes, which ones are making the best money. Things that are going to be just more value as far as opportunity cost goes compared to getting on QuickBooks, filling in how much you had in this expense, that expense. It's a waste of time when you can pay someone $150 to $250 a month to do the bookkeeping on each property. So yeah, make it passive, make it make you as much money as possible. That's the whole idea behind rental properties. But the more that you have bookkeeping done and the more amount of properties that you have, the easier it is. It's like the bank being able to actually see what's going on. If all they have is your tax returns, then they're going to be well behind where you're actually at. So give them the information that they need to make it so you're a big step ahead of where you were before, and you can do, like I said, 2, 3, 4, 5 more properties per year, compound that over time, and it's going to make the world of difference. Now, rental properties are amazing because they are going to give you a passive income. So let's say you make $10,000 off each property per year. So you make $10,000. It doesn't seem like a whole lot of money, but you start doing a bunch of them, and it's really going to be huge. Not to mention you're also gaining the equity. So if you did profit of $10,000 and it's a $500,000 home, you're probably gaining, around $10,000 a year just in equity. I don't know, I'm not going to do the exact math, but you're gaining good equity each year and you're gaining the actual cash. But the cool thing is you're not going to pay taxes on this $10,000. Why? Because we're going to depreciate the home. We might get $5,000 to depreciate just for the home, cost of the home. And then you're going to take, let's say you do some upgrades, you put in a new washer, new dryer, it's furnished, so you furnish the whole thing. You might be at $25,000 negative. So now you've got a $20,000 loss to take against your other passive income. So let's say you have passive income on some other properties that are doing even better. This can now lower your passive income. So you're saving more and more money from these rental properties. Normally it's the ones that you've had going for a long time that are profiting the best. The brand new ones are going to be the ones that you're going to have more of a negative number. which is going to help to balance out. So that's the whole idea. At least, you know, you hear Donald Trump did this, or Mitt Romney, and the amount of taxes they pay, it's unfair. That's just not the case. Anybody can do these things and take advantage of them. If you just work hard, and I mean, all you got to do is start with one property. Once you have one, you know you can get another. Once you have another, you know you can get 2, 3 more. It's all about working hard and knowing exactly what you want. And then once you're getting what you want, planning it all out right. So in this case, you know, you're gonna just have a good outcome. You're not paying any tax on this $10,000. Plus you're actually saving money on other income that you had. So you got to take that into account. You made 10 grand, plus you made 10,000 in equity, plus you saved another $5,000 in taxes elsewhere. So you made $25,000 off of that property, not $10,000. So keep that in mind. It's a big, big deal to realize what you're getting, realize that it is a lot bigger than it kind of feels like when you're only making the 10K in cash. It's a lot bigger than that. Equity is where it's at. Equity is what I'm all about with building companies. Trying to build this equity so that one day you can sell out and get a big payday. Because one big payday at once, to me, is worth a lot more than a little bit every month or every 2 weeks. You know, I hope you probably agree with me. But yeah, so another big cool strategy with rental properties is something called a 1031 like-kind exchange. And I'm going to do a whole separate video on like-kind because it is kind of complex, but I'll give you a quick breakdown. When you sell a property, if it's not your personal home, if it's a rental property, you're going to have capital gains tax. So let's say you bought the property for, let's say you bought it for $500,000. And then over the course of X amount of years, you take depreciation. Let's say you depreciated $200,000. And then, so now your basis is at $300,000. Let's say you sell the property for $600,000. So you've got $300,000 that you're going to have a capital gains tax on. So $300,000 cap gains. Now that's a big amount of money to have to pay capital gains on. You might be paying 20% on that, or $60,000. Big chunk of money. Obviously you got 300, so it's not a huge deal, but why not pay zero tax on that if possible? If you plan right, you can, but you definitely have to plan. You can't just find out about it when you go to sell and be like, oh, that's what I want to do. No, you actually have to actively plan, because you're going to have to tell the banks that you have this property picked out, and that you have to buy it within 90 days of selling this property. So you really got to plan it out. But the cool thing is if you've got a like-kind property that is, you know, in the same value range, let's say it's, let's say it's $600,000, you can just transfer over all of this into the new property. So now you're transferring over your $300,000 in basis into the new property to a brand new property that you can then start depreciating again. So you can do that forever. You can do one property after the next, after the next. I've worked with, I won't say his name, but I worked with some big time real estate guys that has done this in his entire life. And he says all the time, I will never pay taxes on this. My kids won't even pay taxes on this, because it's all about planning. And as long as the loophole is there, then you're going to do it. And I do quotations with loophole because loophole is a bad word, in my opinion, has a bad connotation behind it. Makes you kind of feel like, oh, they're doing something to skirt around this or that. Really what it is it's an opportunity that you can take. You can choose to take the opportunity, or you can choose not to. and it's stimulus. It's stimulating the economy. That's the reason why these things are put into the code. It's to stimulate the economy. So it's basically getting someone to decide to buy another property instead of taking that money and hoarding it in the bank. So super important to know these types of things when you go to sell the property. Another super cool thing that I'll do another video on later is going to be cost segregation, or cost seg for short. It's when you say you buy I just did one of these 2 years ago. Say you buy a $2 million property, and you've got a lot of income that year. You've got $500K of taxable income. You really need a break. So you take that $2 million property, which would normally get you depreciation of, maybe $50K total for that year. You're gonna segregate or separate all of the different types of expenses in the building. So the carpeting, the wiring, the walls, everything gets separated, electrical. And they separate it all and say, okay, these have a useful life of 5 to 7 years, whereas the structure of the building has a useful life of 30 years. So we're going to depreciate the 5 to 7 year stuff in over 5 to 7 years. So it might raise your your depreciation from 50K to 400K. Those numbers, obviously, they're not exact or anything, but it's a huge difference between 50K write-off and 400K write-off. So you need to plan out the size of the buildings that you're doing, the types of the buildings that you're doing, so that you're getting the best tax outcome instead of just saying, I need a rental property. You want to make sure it's the right rental property to get you the exact tax outcome that you're looking to get. Now we'll go into these a lot more in another video, but for now, hopefully that helps.